Hi, I'm Kadie.
And I'm Bella, and this is our Managing Finance presentation.
In this presentation, we're going to be discussing our potential investment options for the client and we'll be discussing their objectives. We'll then be discussing the investment portfolio, which is made up of commercial property, shares, bonds, and cash. And we'll discuss how much we think they should allocate to each of their investments. For each of them, we'll also evaluate the risk and return and how they align with our client's goals. We'll also be discussing efficient markets hypothesis further along in the presentation.
Okay, so this is a slide about the client that we're providing this investment portfolio for, and just a bit about their objectives. So our client has recently inherited £100,000. They're a young, risk-tolerant investor with low fear of volatility. They want a portfolio which gives them a balance between risk and return, as well as liquidity and growth. They also want to maximise long-term growth with an aim of high risk and high returns. They'd also like to be made aware of the risk return characteristics as well as the tax implications that come with each investment.
So commercial property is buildings and they're used for business activities. So an example of this could be an office in a town centre. Our suggestion is that they should invest £10,000 into it as it provides passive income through rental yields. It would also supply our client with a steady income, and the expected return of this is 7.7% according to Alan Boswell Group. It would be a medium and high risk as it can be quite illiquid in the short and long run, as if you have buildings that are vacant, they might not make as much profit from it. It can also have some disadvantages though, which could be how long it takes to sell, as there's very low liquidity and there's maintenance costs. Investing in commercial property might also incur a stamp duty land tax, which would just be a tax based off the land that they own. And if wanting to invest in property, but there could be a minimum spend altogether.
So the next investment suggestion we've got for the client is to invest £55,000, so 55% into shares. So if buying shares means that you become part owner of a company, basically, and the bigger the investment you make, the bigger the return, and also the bigger the stake that you have in that company. So in terms of the client's goals, so like growth and liquidity and things, so the growth and returns can be high in the long run, and liquidity is very high as you can sell shares at any point. They also provide income through dividends, so what the company, based on the company's performance. Again, based on the company's performance, the risk can be high or moderate to high because they can fluctuate depending on how they're performing. And then if you were to calculate the shares, then you would use the Gordon growth model, which is a forward-looking model used to estimate the value of a firm's stock. And then, so if you were to invest in shares, then a stable investment would be investing in a bank or utility, as they are always going to be in demand. However, our suggestion as a company to invest in will be Microsoft, and then Kadie's going to go through this next.
So a company that we would suggest that they invest in would be Microsoft, as they're a company that uses AI, which has become quite relevant these days, and technology is important for the future. Here are some figures on Microsoft that we found about their profit margins, and they're all quite high. So why we would invest in Microsoft is because they've got a strong financial performance in areas like profitability and growth, and they've got a high innovation focus, which we think would be important for our client who wants long-term investment. And we also think this is good for them as the average return is 26.05% based on the finance charts of this year. A bond is a loan taken out by companies or governments. So if you invest in a bond, you're lending money to a company or a government for a specific amount of time, and during that time you'll receive a fixed interest payment. This is information based from Lloyds Bank. Our suggestion is that they would invest £30,000, which is 30% of the 100,000. There are also two types of bonds. So the ones we'll be talking about today is government and corporate bonds. They both overall reduce the risk and they provide stable returns. So they're very low risk. And they're also medium liquidity because they're easier to sell than commercial property would be, but they're not as liquid as stocks. So here is a comparison between the types of bonds. So government bonds are issued by governments and they're usually considered low risk, and corporate bonds are issued by companies and they're usually considered riskier than a government bond would be. So for an investment, they would work by giving an interest payment twice a year, so it'd be a steady income, and you'd also sell it at a different price at the end of the bond. However, they do come with risks. So one of the risks would be interest rates. If the interest rates rise, they become less attractive than if the prices drop. And a long-term bond are considered riskier. So we would decide that they would invest in corporate bonds due to them being riskier and this matching the qualities of our client. So the reason why we're investing in bonds is because it provides a steady income. So the income's paid twice a year, and this is where our portfolio becomes more stable. When also investing in stocks, it helps balance out the risk between them. They're also less volatile and they don't require as much management that stocks would do. So we would invest in corporate bonds where investors can expect a 4 to 6% annual interest on a high quality corporate bond, meaning that it would provide higher income.
So the final part of the investment portfolio that we're going to suggest that the client invest in would be £5,000 of cash, so into like an ISA. So investing cash is very liquid and it can be used for short-term liquidity and emergencies. However, this should not be relied on for long-term growth. It's very low risk as you only really risk losing the money that you've invested. However, all the interest is that you make from investing this is taxed. And then just at the bottom there, so that's just something that's come from Santander as an example. So that's based on their easy access ISA returns. And if you were to invest £5,000 into a cash ISA for 5 years, the returns would be 6.1%. So this is a graph that we've put together comparing the risk and return of each of the investment suggestions that we've suggested the client to invest in. And as you can see, the shares and bonds have the higher returns in comparison to the risk. So that's why we've chosen to invest the most money into them two. And then just to like kind of summarize in each of the boxes around the side. So cash is low risk with low return. Shares is high risk with high return. Bonds is moderate risk, moderate return, and property is a medium to high risk with a moderate return.
Here are the tax implications on each of the investments. So the first one being stocks, you would pay dividend tax on any payouts that you receive from companies. So the tax you receive from a company, you'd pay a certain percentage of tax on this income. The next one, commercial property. Your clients who use the buildings that you have would pay rent, and this income is also taxed. And bonds, any interest payments from this is taxable. And cash savings, so this would depend on the type of account you have. You would get interest paid on the cash you have in each ISA. This also depends on the company you have the ISA with, and you can only invest £20,000 in each one, and you can only invest in one annually.
And then capital gains tax, so this would be on stocks, commercial property, and also bonds. So this is whenever you sell, like I said, either stocks, commercial property, or a bond. So for example, someone might choose to sell a bond before maturity if it is predicted that interest rates might go up, as it wouldn't be as attractive. And just to kind of summarise what capital gains tax actually is, so for example, if you were to buy a car for £1,000 and then sell it for £1,500, you would pay capital gains tax on that £500 that you made extra.
So here are some factors that could influence the investment decisions. So one of them being investing in the UK might be better than investing in emerging markets because emerging markets can be more riskier than the UK because they don't have as many regulations as we do. Another one being inflation. So the UK's government target of 2% may change. So this would affect the cash you would invest in your ISAs because it loses the purchasing power. As if the inflation rate is higher than the interest rate you have on your accounts, then you wouldn't be making a significant amount of money. And also the interest rates, which we just discussed. And another one being efficient market hypothesis, which Bella will be discussing next.
So this is the efficient markets hypothesis, which is something that should be considered when thinking about the investment suggestions that we've talked about previously. So this is basically an investment theory that suggests that it's impossible to beat the market, because basically all past information is irrelevant and future figures are random and can't be predicted. So there's three different variations of this. So there's weak form, semi-strong form, and strong form. So weak form is basically all past prices and returns, so like all past market information. Semi-strong form, which is all public information, and then strong form, which is public and private information. So private information is things that haven't yet been released, but this might be leaked via like someone that's been researching and predicted things and then leaked it to the market before it's actually been let out to the public. So this is something that should be thought about when thinking about investing. So this is a slide about the implications of the efficient markets hypothesis on investment decisions, specifically the decisions we've spoken about previously in this presentation. So investing in shares and bonds, this hypothesis should be considered because basically, although that the past information can be used to follow trends and whatever, the hypothesis suggests that the market can't be beaten and whatever happens in the future cannot be based off the previous information and the averages. However, cash is has no implications with this hypothesis. So this is just a table summarising the qualities of each of the investment options that we've suggested for this client. So it talks about the allocation, so how much money to allocate to each of the investments, the liquidity, the growth, the risk, return, and also the tax implications of each of the investment decisions. And as we can see, the highest liquidity and growth, risk, and return would be shares and equities.
So here is a summary about how our investment decisions link with the client's goals. So just a reminder of the goals, which were a balance of liquidity and growth and risk and return and maximizing long-term growth. So by investing in property, it provides our client with a stable income, meaning that there's still a balance between the portfolio, and the same with bonds. They have a moderate liquidity and growth, but they still remain stable and they're low risk. And shares links with our clients' goals of having a high return, as shares offer the highest amount of return. And then finally, cash. It allows our client to deal with short-term liquidity problems and any emergencies that may occur. And here is our reference list for the decisions that we've made. Thanks.
Thanks.